Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about KB Home Annual Report. KB Home offers a wide range of businesses and services that cater to the needs of homebuyers across the United States. At the core of their operations are home building services, which include constructing and selling various types of homes, such as single-family residential homes, townhomes, condominiums, and attached and detached homes. In addition to home building, KB Home provides financial services to its customers. This includes mortgage banking services that facilitate residential consumer mortgage loan originations for homebuyers. The company also offers property and casualty insurance services, which cover earthquake, flood, and personal property risks. Furthermore, KB Home provides title services to ensure a smooth transfer of ownership. The company operates in multiple states across the country, including Arizona, California, Colorado, Florida, Idaho, Nevada, North Carolina, Texas, and Washington. With its extensive reach and diverse range of services, KB Home has established itself as a leading homebuilding company in the United States. The stock price of KB Home has experienced a significant decline over the past year, with a drop of minus 15.72% in value. While there were no single-day drops exceeding minus 12.98% due to reported news events, two notable declines occurred due to earnings reports that did not meet expectations. In December 2025, KB Home's shares fell by 8.8% after the company released its fourth quarter results. Although earnings and revenue surpassed Wall Street forecasts, a weak outlook for 2026 and continued year-over-year declines in revenue and profit overshadowed the positive results. Analysts subsequently lowered their price targets on the stock. Similarly, in March 2025, KB Home's stock declined by 7.15% after the announcement of its Cone 2025 financial results. The company reported earnings per share, EPS, that missed forecasts, as well as revenue that fell short of projections. These disappointing earnings reports likely contributed to the decline in KB Home's stock price over the past year. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline for KB Home are multifaceted. On one hand, revenue growth is driven by home sale transactions, which are recognized when title is transferred to the homebuyer. Sales incentives, recorded as a reduction of revenues, also contribute to revenue growth. Additionally, customer deposits related to sold but undelivered homes included in accrued expenses and other liabilities can impact revenue growth. On the other hand, revenue decline drivers include decreased net orders, average selling price decreases, and price reductions implemented as part of a simplified sales strategy. Changes in market conditions for any given asset, increased land development costs imposed by municipalities, and decisions to change operational strategies also contribute to revenue decline. Economic conditions, such as interest rate increases or decreases affecting variable rate debt, can impact revenue growth or decline. Housing market conditions, including favorable demographic trends, ongoing structural undersupply of new homes, and challenging market conditions in 2025, also play a significant role. Operational capabilities, such as high customer satisfaction levels, improved build times, lower construction costs, and balanced pace and price optimization, are essential for revenue growth. Overall, KB Home's revenue growth or decline is influenced by both internal and external factors, requiring the company to adapt its strategies to navigate changing market conditions and maintain a competitive edge. Net income for the company decreased significantly from $655 million in 2024 to $428.8 million in 2025, marking a 17% year-over-year decline. This downturn was largely attributed to a decrease in net orders and average selling price. Furthermore, abandonment charges also contributed to the decline, increasing by $16.5 million from 2024 to 2025. Profit margins also suffered as a result of these changes. Housing gross profit margin decreased from 21% in 2024 to 18.6% in 2025, and is expected to further decrease to 15.4–16% in Cone 2026. This decline was partly due to increased selling, general and administrative expenses as a percentage of housing revenues, which rose to 10.4% in 2025. The reasons behind these changes are multifaceted. Lower housing revenues resulted from decreased home deliveries and lower average selling prices. Strategic price reductions were implemented in response to softer market conditions, while inventory-related charges increased, partly offsetting the decrease in operating income. Additionally, higher relative land costs on the West Coast and a decrease in home deliveries on both the West Coast and Southwest segments also contributed to the decline in net income and profit margins. The company's financial performance indicates a strong ability to generate cash from its core operations. According to the data, the net cash provided by operating activities in 2025 was $428,800 million, which is a significant positive figure. This suggests that the company has been successful in managing its day-to-day business activities and generating sufficient cash to meet its financial obligations. Furthermore, the company's ability to generate positive operating cash flow in 2025 is a testament to its operational efficiency and effectiveness. The fact that it was able to produce a substantial amount of cash from its core operations indicates that the company has been able to optimize its business processes and manage its resources well. This is a key indicator of a company's financial health, as it shows that it can generate sufficient cash to invest in growth opportunities, pay off debts, and reward shareholders. In conclusion, based on the data provided, it is clear that the company is generating positive operating cash flow, which is a significant achievement for any business. This indicates that the company has a strong financial foundation and is well-positioned for future growth and success. The company's debt level and interest expenses have undergone significant changes over the past year. In terms of debt level, while there are mixed signals, the overall trend suggests an increase. The aggregate principal amount of outstanding senior notes rose to $1.34 billion, and the total debt increased to $1.2 billion with a new credit facility. However, the notes payable decreased to $1.7 billion, and the debt-to-equity ratio only increased by 0.9%. This indicates that the company's debt level has not changed significantly. On the other hand, interest expenses have seen a notable increase. The total interest incurred rose by $8.3 million, 8%, from $105.6 million in 2024 to $113.9 million in 2025. Additionally, interest expenses increased due to higher variable interest rates based on SOFR. This suggests that the company's interest expenses have changed significantly over the past year. The management of the company is expressing a cautious outlook for the short term due to expected higher warranty claims and costs, as well as ongoing inflationary pressures. However, they are optimistic about their long-term strategy, which involves investing heavily in land development and entering new markets to gain share and scale. To manage risks, the company has implemented self-insurance programs, including a captive insurance subsidiary, and is prioritizing capital efficiency in land development. They also plan to return capital to shareholders through share repurchases and quarterly cash dividends. In terms of operational strategy, the company will continue to focus on delivering completed homes to homebuyers with a wide variety of designs appealing to different demographics. Decisions will be made based on profitability measures such as housing gross profit margin and pre-tax income loss. Overall, the management's outlook is focused on balancing growth initiatives with risk management and capital allocation, while acknowledging potential challenges and uncertainties that may impact their performance. The company has made several key acquisitions and divestitures in its business operations. Acquisitions have been a significant part of the company's strategy, with a focus on acquiring land parcels that meet specific investment return standards. This includes purchasing entitled land within attractive submarkets, as well as investing in unconsolidated joint ventures that conduct land acquisition and development activities. Additionally, the company has entered into land option contracts with third-party financiers or developers to secure future land purchases. In terms of divestitures, the company has identified potential opportunities for selling land held for sale at a loss. This may involve disposing of land parcels that no longer fit into its strategic operating plans or are zoned for non-residential development. By regularly reviewing and adjusting its portfolio, the company can optimize its asset base and focus on high-potential growth areas. The company has a history of rewarding its shareholders through various means. One way it has done this is by paying dividends. In fact, the company has confirmed that it has paid dividends in both 2024 and 2025. For those interested in specific details, they can refer to page 47 for more information. In addition to paying dividends, the company has also taken steps to return value to its shareholders through share buybacks. Over a certain period, the company repurchased a significant number of shares, totaling 9.4 million. The total cost of these purchases was $538.5 million. For those who want more specific details on this transaction, they can refer to page 32 for the exact numbers. Concerns about inventory buildup and supply chain disruption are widespread across various aspects of the industry. One major concern is the potential for inventory buildup due to strategies adopted during the 2020-2024 period to navigate supply chain disruptions, which may lead to a mismatch between the mix of homes delivered and historical averages. Supply chain disruptions are also a significant concern, driven by factors such as craft and skilled trade shortages, upward cost trends, and elevated construction activity. The potential for production delays and inefficiencies, if qualified contractors are not available or do not timely perform, is another area of concern. Inventory buildup is further exacerbated by the abandonment of previously controlled lots that no longer met underwriting criteria, reduced employment levels, job/wage growth, population growth, household formations, and other unfavorable demographic changes. The lack of available land, delayed community openings, and home starts also contribute to supply chain disruptions. The impact of tariffs, duties, sanctions, and trade restrictions on materials such as steel, aluminum, and lumber is another area of concern, as is the need for reformulation or redesign of building materials or components due to limited or restricted supply. The potential for poor contractor availability and performance also poses a risk to inventory buildup and supply chain disruption. Overall, the industry faces significant challenges in managing inventory levels and navigating supply chain disruptions, which could have far-reaching consequences for businesses and stakeholders alike. That concludes the financial summary for KB Home. Feel free to comment below, and I will be happy to answer them when possible.